When you hear the word long-term care, it's probably not a friendly thought that comes to mind, especially if you think into the future and the implications financially and emotionally needing to either have someone come to your house to care for you or you to go into assisted living. And another word that probably comes to mind for you when you think about long-term care is expensive. Long-term care is expensive, and so are the options in some cases for paying for long-term care, such as long-term care insurance. And we'll call long-term care insurance number 1, traditional approach. The traditional approach is to pay a monthly premium and that monthly premium gets you something. In this case, it gets you about $150 a day in the future for long-term care. Either that's in-home care or being in a nursing facility. And the only thing this does provide is long-term care. Unfortunately, when you buy long-term care insurance, the bet you're making is, at some point in the future, I will need long-term care. Now, what happens is if you don't need long-term care, but you plan for it, is all the money you put into traditional long-term care insurance is gone. There's no way to get it back. The other caveat, most families that have long-term care insurance today, especially in retirement, will get a letter from their carrier saying that their benefit has dropped. They don't have to do anything, but their benefit has dropped. To keep their benefit the same, their monthly premium will go up. However, this isn't the only solution for long-term care, although it's the most popular, and you've likely heard about it. The other option is lump sum long-term care. However, this option is a little different. With this, you also get a death benefit and cash value. Usually, you'll put a lump sum into it at first, let's say $30,000, and that's it. And that is to be put aside to pay for your future long-term care needs, still an insurance product. The advantage with this over that, however, is, number 1, you can fund it all at once using some liquid money or money that just came out of a CD. And there's a death benefit with the policy. And that death benefit's typically a little more than what you put in. But let's say that the bet you made was, I need long-term care in the future, and you end up not needing it. Well, you can always access the cash value and take out what you put in. So in this way, you have an exit strategy compared to not having an exit strategy with option number 1. Your third option is a life insurance policy with a long-term care rider. That provides for long-term care, it has a death benefit, and cash value, like option 2. However, with this is primarily an insurance product. You'll have a death benefit, let's say it's $500,000. And that death benefit can be tapped while you're alive. Sometimes as much as 80 or 90% of it for long-term care. They call it accelerating the death benefit. On the other hand, you will still have cash in the policy that you paid into as premiums that can be taken out as well. And that money gets invested. Now options 1 and 3 do require that you go through underwriting to check your health, make sure you're in a somewhat good condition. Option 2, though, only requires a 30-minute phone call. When you're considering all of your options, it can be confusing, and it's important to have someone there to help guide you to make the smartest decisions possible. If you liked today's video and found it informative, I encourage you to give us a thumbs up and subscribe so that you can get access to our other content. If you didn't like today's video, please give us a thumbs down or drop a comment and tell us so we can improve. We'd love to improve. And with that said, we'll see you next time.